Well, the March quarter was quite eventful, not to mention the first few days of April, during which Trump announced his sweeping tariff retaliations. Global equity investors experienced sharp declines in stock prices. Now, periods like these always feel a bit unpleasant, but rest assured that Montaka's portfolio companies remain advantaged, highly profitable, and cash generative. Importantly, we assess their future prospects to remain very attractive, which we think will result in the aggregate earnings power of Montaka's portfolio companies to grow substantially over time. And we believe the reliability of this growth remains underappreciated by the market today. Business fundamentals and valuation discipline remains our twin North Stars, and these help us avoid distractions and detractions amidst the very noisy global financial markets. US equities collapsed over recent weeks as the Trump administration unleashed its unique brand of unpredictable politics. Trump sporadically announced tariffs, then backtracked, then forward-tracked. The president flipped geopolitical alliances on their head. He loosely threatened Canada with annexation, while the US voted with Russia at the UN General Assembly and against Europe for the first time in about 80 years. Interestingly, across the pond, European equities were booming, especially in Germany. And this may feel like somewhat of a paradox, and nowhere is the feeling of uncertainty stronger today than on the European continent, following Trump's threats to revoke European security guarantees that have been in place since 1945. But it was precisely these threats that catalysed German politicians to move swiftly and efficiently to approve its enormous new fiscal package focused on defence, security and infrastructure spending. And this is the primary reason why European equities performed so well during the quarter. Now that said, while the short to medium term now looks prospective, we remain cautious about Europe as a longer term fruitful home for Montaka's capital on fundamental grounds. So as we shared in a Monocle essay this month, there are several long-term structural headwinds to equity returns in Europe, including competitive disadvantages relative to US companies, productivity deficiencies driven by regulatory burdens and other excessive policies, eroding demographics, elevated debt levels, and national security risks. So when viewed through a longer-term prism, we continue to assess the US as one of the best markets in the world for investment opportunity. And interestingly, Brookfield Asset Management, the CEO, Bruce Flatt, underscored this view in a rare podcast interview recently. He said, quote, "The story of America is extremely strong because the US today has energy, capital, and technology dominance." Back in the US, and there's no question that President Trump's tariff announcement have caused mass turbulence in equity markets over recent weeks. That said, many believe that such tariff politics will prove to be temporary. And while we make no attempt to predict Trump's future behaviours, the tariffs are undoubtedly a source of leverage that can be employed by Trump in some kind of future deal. Interestingly, Trump's own chair of the Council of Economic Advisors wrote explicitly last year that tariffs could be used to tactically build up leverage for much larger negotiations involving national security, defence spending, and currency exchange rate targeting, i.e. a weakening of the US dollar. So, if so, this would support the hypothesis that the current market weakness is temporary. And we also note that even Fed Chair Jerome Powell said in recent days that he believes higher inflation stemming from President Trump's tariffs will be transitory. So let's see. At the same time, we believe there are many longer-term opportunities that remain intact, supported by recent quarterly company earnings disclosures. AI remains a very important long-term investment opportunity in our view. While some observers see too much hype and are calling for caution, our research continues to point to large opportunities ahead. CEOs of the world's largest cloud computing platforms, those with arguably the most accurate line of sight into future demand for AI compute and services, are unanimously pointing to a large opportunity ahead based on demand signals they are seeing today. And across the board, they remain capacity constrained and are substantially increasing their capital investments in AI infrastructure. Now, with the enormous capital spend being made to expand this AI infrastructure capacity, i.e. US dollar 300 billion is being spent this year alone from just 4 companies, Amazon, Microsoft, Alphabet and Meta, some are wondering if this is all too much. Of course, if the returns on these investments do not materialise, then these represent a large-scale squandering of shareholder capital. This is an important question for investors to wrestle with carefully. It is always possible that demand forecasts prove to be too optimistic. In this case, however, we know the following salient points. Number 1, external enterprise adoption of AI applications, such as Salesforce's Agentforce, remains in its infancy, having only been available for a handful of months. But in Montaka's private discussions with customers who are in the process of adopting Agentforce, there are genuine use cases where this technology is unlocking substantial productivity gains and is already resulting in lower headcount needs. Number 2, internal use cases are proven and capacity is fungible for many of those who are making these enormous investments. So Google, Meta, Tencent and others have all demonstrated firsthand the enormous value that AI can unlock within their core businesses. And given that AI infrastructure is mostly fungible across use cases, substantial internal demand helps reduce the risk of poor returning excess capacity. And number 3, the underlying AI models continue to improve, most recently in the form of chain of thought reasoning models. At the same time, custom design AI chips are helping to drastically reduce the cost to serve, and this combination is obviously positive for adoption across enterprise and consumer use cases. And I will say, even Montaka's internal research team, we've substantially evolved our workflows over recent months to incorporate these new technologies to unlock real productivity gains. So the point is, if the demand is there and advantage companies like those just mentioned can generate good returns on this spend, then shareholders should actually want capital investments to be as large as possible. The costs of underinvestment in such a scenario, while hidden from the company's financials because they're opportunity costs, can actually be devastating. So we remain very positive on the AI investment opportunity for Montaka's advantaged portfolio companies. Away from AI, long-term opportunities in the financial sector are also building. For example, there is every indication that large-scale financial deregulation is coming in the US. So recent comments from industry figures, as well as private comments made to Montaka in recent expert interviews, consistently point to substantial regulatory relief on the horizon. So from reduced capital requirements to increased investor access to alternative asset strategies, for example, to tax cuts, these are all positive for risk assets in the short to medium term. And so through this lens, we view the recent 35% reduction in KKR's stock price, for example, as a buying opportunity. While short-term asset monetizations are clearly on pause due to the recent market turbulence, and this will impact Q1 transaction fees and capital raising, things like that, the longer-term earnings trajectory for KKR is only improving. Montaka's decision to buy or sell a stock is guided by our portfolio construction framework centered on price versus value disciplines. So under this framework, we are guided to allocate portfolio capital in a way that carefully increases the odds of long-term upside while limiting the odds of permanent capital impairment. On this basis, Montaka trimmed the positions of Spotify and S&P Global during the March quarter and added to the positions of KKR and Floor & Decor. Now, some market values have become far more attractive by the quarter end and the beginning of April. For investors such as Montaka, this means opportunities as we are able to look through the uncertainty of the next few months and years and instead remain focused on fundamental advantages, risks, and the valuations of extremely attractive compounding businesses. And showing on the screen now is a summary of Montaka's top 10 investee companies at the end of the March quarter. Patience is key to successful long-term investing, and today global politics and market volatility are certainly testing the patience of all investors. We remain committed to carefully assessing the long-term opportunities we see, relying on fact-based research and analysis and remaining unperturbed about the popular market narrative of the day. So with that, we thank you for your ongoing partnership, patience and trust you have placed in us to carefully manage and grow your capital over time.